Welcome to The Explainer. Today, we're diving straight into the massive relief rally that hit the markets after the US-Iran ceasefire. Now, while it feels like we've dodged a bullet, the underlying economic risks and geopolitical fragility are, well, they're still very much there. We're going to break down what all of this means for India's economy, for corporate earnings, and for you. Just a few days ago, this was the number that was keeping everyone up at night. $130. That's where oil prices were heading. For an economy like India's, which is so dependent on energy imports, that number isn't just high, it's basically a code red for a systemic crisis. It threatens to kick off runaway inflation and just completely derail economic growth. And this timeline really shows you just how close we got to the edge. You see, on the evening of April 7th, with a US deadline for more strikes just hours away, a last-minute mediation effort managed to pull everyone back. The result? A shaky, conditional 2-week ceasefire that, when the markets opened, sparked an absolutely euphoric relief rally. Okay, so here's our game plan. We'll start with the truce itself, what's actually in the deal. Then we'll look at how India managed to absorb the economic shock. We'll identify the key winners and losers in the market, then dig into the logistical nightmare happening in the Strait of Hormuz. After that, we'll see how this all trickles down to the consumer, and we'll wrap up by looking at why this is really just a pause and not a permanent peace. So what does this deal actually look like? The details here are absolutely crucial because they're the things that reveal just how delicate this whole situation really is. Analysts aren't even calling this a true ceasefire. The term they're using is a supervised pause, and the reason for that name is critical. The conflict against Hezbollah in Lebanon is explicitly left out of the deal. For any serious analyst, this is the number one tail risk. Any miscalculation or escalation in Lebanon could make this entire agreement just evaporate, sending markets right back into a tailspin. Alright, let's look at how this geopolitical shockwave hit India, and the serious price that had to be paid to keep things stable. 2 lakh crore rupees. That's the estimated cost to the Indian government to shield the economy from the worst of this. And let's be clear, this wasn't really a choice. It was a massive, necessary intervention to stop the domestic economy from completely spiraling out of control. So where did that huge number come from? Well, it's mostly from deep cuts in fuel taxes and from absorbing much higher fertilizer subsidy costs. But this creates a really direct trade-off. See, the money being used to stabilize prices today is money that can't be used for future projects, like infrastructure. So we're basically trading long-term growth for short-term stability. And you can see this caution reflected in the Reserve Bank of India's own numbers. Even after the ceasefire, look at this, they've actually downgraded their GDP growth forecast to 6.9%. What that tells you is that the central bank sees real, underlying economic damage from this whole affair. They're now walking a tightrope, trying to balance the threat of inflation with a potential slowdown in the economy. Okay, let's turn to the markets. Because this relief rally, well, it wasn't a case of a rising tide lifting all boats. Not at all. It created a really sharp divide, separating the clear winners from the sectors that are still in a lot of trouble. You can see this split perfectly just within the energy sector. On one hand, you have the downstream marketers, companies like HPCL and BPCL. They saw an immediate recovery in their margins. They were facing losses of up to 28 rupees per litre, so that 15% drop in crude prices was a huge relief, and you saw their stocks jump. But on the other hand, the upstream producers like ONGC, whose money comes directly from high oil prices, they saw their whole earnings outlook shrink, and their stocks fell. And the same pattern played out everywhere. Aviation stocks like Indigo just soared, up 10%, because jet fuel is one of their biggest costs. Paint companies, which use a lot of petroleum-based stuff, they also rallied. But then, look at the plastics sector. Even with the ceasefire, their raw material crisis is still raging, keeping their costs sky high and making any recovery look pretty uncertain. So the headlines might be telling you that the Strait of Hormuz is open again. But if you're a financial analyst or a supply chain manager, the reality on the water is an absolute, unmitigated logistical nightmare. 3,200. That's how many cargo vessels, including 800 oil and gas tankers, are stuck in a massive queue in the Persian Gulf right now. This isn't just a traffic jam, it is a critical clog in the main arteries of global trade. And clearing this backlog isn't going to be quick. Analysts think it could take over 3 months. Why? Well, you've got 4 main reasons. First, strict Iranian military oversight on all the routes. Second, reports that Iran is limiting how many ships can pass through to maintain leverage. Third, a lot of shipping crews are refusing to make the trip due to safety fears. And fourth, war risk insurance is still incredibly expensive. This whole mess is going to disrupt Indian supply chains for the entire quarter. So, here's the bottom line. How does all of this complicated geopolitical and logistical chaos actually affect the average Indian household? Let's break it down. Just take a look at these numbers. These are the raw materials for, well, everything. Packaging, car parts, you name it. Polypropylene and polyethylene prices are up around 50%. This is a massive squeeze for small businesses, and you can be sure that this cost is going to get passed on to you, the consumer, over the next few months. And here's another vulnerability, one that's a little more hidden. 40% of the money that Indians working abroad send home comes from the Middle East. That's a huge lifeline, about $50 billion a year. The economic slowdown in the Gulf because of all this conflict is now a direct threat to that income for millions of families. And what about petrol prices? Well, don't expect the relief in crude oil prices to show up at the pump anytime soon. The oil marketing companies are going to use any savings to first fix their own battered balance sheets. So for the average household, the pain of high fuel costs is going to stick around, and that's going to keep a lid on spending. And that brings us to our final, and maybe the most important part of this whole story, just how fragile this moment really is. This is it. This is the one question that every single investor, policymaker, and business leader is asking right now. The market has priced in a huge amount of relief, but has it accurately priced in the risk that's still out there? From a risk management perspective, the answer to that question is a clear and simple no. The major risks are still very much on the table. You've got the Lebanon trigger, which could blow up the whole ceasefire. There's an unresolved dispute over Iran's plan to charge a transit levy for ships. On top of that, about 3% of global refinery capacity is damaged, which puts a high floor under fuel prices. And finally, the strategic risk that Iran could just close the Strait of Hormuz again as a bargaining chip, that hasn't gone away. So what the market has really done is bought itself a 2-week window of optimism. But the fundamental tensions, the unresolved issues that brought us to the brink in the first place, they're all still simmering right below the surface. This ceasefire isn't a stop button, it's a pause button, and it leaves all of us just watching the clock, wondering what's going to happen when that time runs out.